Ladies and gentlemen, we need to stop and appreciate what just happened. We need to take a moment to recognize that we are standing at the beginning of 2026, having just witnessed the most explosive year for silver in modern history. 148%. That is not a typo. That is not an exaggeration. That is the verified, documented gain that silver delivered in 2025. The metal that was dismissed as boring, the metal that was called a relic, the metal that mainstream analysts said would never break $30, just delivered returns that would make the hottest tech stock jealous. And here's what should terrify the shorts and electrify the bulls. The conditions that created that 148% surge have not disappeared. They have intensified. Every single tailwind that pushed silver from the 20s to above $74 is still blowing, and several new tailwinds have joined the storm. We are not at the end of this rally. We are at the beginning of its next phase. Today is Friday, the first trading day of 2026, and silver is climbing again. We are trading near $74.10 per troy ounce in the early European session. The momentum from 2025 has carried directly into the new year without missing a beat. There was no pause, there was no consolidation, there was no reset. The buyers stepped in immediately and pushed prices higher because they understand what is coming. They understand that the fundamental picture has never been more bullish. They understand that we are witnessing a convergence of factors that happens perhaps once in a generation, and they refuse to be left behind. Let me break down exactly what is driving this price action, because this is not random speculation. This is not a meme stock pump. This is a logical, fundamental response to a set of conditions that make higher silver prices inevitable. The first and most powerful driver is monetary policy. The Federal Reserve, the institution that controls the most powerful currency on earth, is about to embark on a rate-cutting cycle that will fundamentally alter the investment landscape. Traders are now pricing in 2 more rate cuts in 2026. This is not speculation. This is what the futures markets are telling us. The probability of rates remaining unchanged at the January meeting sits at approximately 85%, but the trajectory for the rest of the year is clearly lower. Why does this matter for silver? Because silver is a non-interest-bearing asset. When interest rates are high, there's an opportunity cost to holding silver. You could put your money in treasury bonds or money market funds and earn 5% risk-free. Why hold silver, which pays nothing? But when rates are falling, that opportunity cost shrinks. When rates are falling, the relative attractiveness of hard assets increases. When rates are falling, investors start looking for alternatives to paper currencies that are being systematically devalued. Silver becomes not just attractive, but necessary. But the Fed story gets even more interesting because we are about to see a potential change in leadership that could accelerate this dovish pivot. Jerome Powell's term as Federal Reserve Chair ends in May. Markets are now bracing for President Donald Trump to nominate a replacement who could be even more aggressive about cutting rates. We have all heard Trump's views on monetary policy. He has been vocal for years about wanting lower interest rates. If he appoints a new Fed chair who shares that view, the rate-cutting cycle could accelerate beyond what is currently priced in. The implications for silver and all precious metals would be profound. Now let us talk about the US dollar, because this is the second major tailwind that is pushing silver higher. The dollar index has slipped to approximately 98.2 on this first trading day of 2026. This extends last year's decline, which was nothing short of historic. The greenback shed nearly 9% in 2025. That is the steepest annual loss in 8 years. The dollar, the world's reserve currency, the foundation of the global financial system, just experienced one of its worst years on record. And the factors that caused that decline have not been resolved. Policy uncertainty remains elevated. The fiscal deficit continues to balloon. Interest rate advantages relative to other currencies have narrowed. Concerns about the long-term sustainability of U.S. debt are growing. Why does a weaker dollar matter for silver? Because silver is priced in dollars. When the dollar falls, silver becomes cheaper for foreign buyers. A Chinese investor, a Japanese institution, a European fund manager, they can buy more ounces with their local currency when the dollar weakens. This increases demand. It brings new buyers into the market. It creates a natural floor under prices. The 9% dollar decline in 2025 was a direct contributor to the 148% silver rally. If the dollar continues to weaken in 2026, and the fundamentals suggest it will, silver will have another powerful tailwind at its back. But monetary policy and currency movements are only part of the story. The physical fundamentals of the silver market have reached a state of extreme tightness that demands attention. Silver has been officially designated as a critical U.S. mineral. Let me repeat that because it is extraordinarily significant. The United States government has recognized silver as a strategic resource, essential to national security and industrial competitiveness. This is the same designation that has been applied to rare earth elements and other critical materials. It signals that silver is no longer viewed as just a precious metal for jewelry and coins. It is now recognized as an essential industrial input that the nation cannot function without. This designation reflects the reality on the ground. Stockpiles are at historic lows. Supply chains are stretched to the breaking point. Inventories in the major vaults, in London, in New York, on the COMEX, have been systematically drained over years of structural deficits. There is simply not enough physical metal available to meet demand. And that demand continues to grow relentlessly. Industrial consumption is soaring. Solar panels require silver, electric vehicles require silver, semiconductors require silver. Every technology that will define the 21st century depends on the unique properties of this metal. And now we need to talk about what is happening in China, because this is where the situation becomes truly explosive. Shanghai futures exchange premiums have surged to record highs. This is not a minor fluctuation. This is a historic divergence that signals panic buying in the world's largest market for physical commodities. Chinese buyers are willing to pay massive premiums above the global benchmark price just to secure physical metal. They are not trading paper contracts. They are taking delivery. They are moving silver into private storage. They are treating this metal as a strategic asset that must be secured at any cost. These elevated Shanghai premiums have tightened global supply chains even further. The metal that was supposed to flow from China into the global market is now staying in China. The world's largest refiner of silver has effectively reduced its exports through a combination of policy restrictions and domestic hoarding. This echoes the inventory squeezes we witnessed in London and New York vaults. The same pattern is repeating in Shanghai, but on a larger scale with more significant implications. Think about what this means for the global market. China controls 60 to 70% of global refined silver supply. When Chinese buyers are paying record premiums, when Shanghai stockpiles are being drained, when export restrictions limit the flow of metal out of the country, the rest of the world faces a supply crisis. There is nowhere else to get the metal. There are no alternative sources that can fill the gap. The mining industry cannot increase production overnight. The recycling industry cannot scale up fast enough. The physics of silver scarcity are asserting themselves, and prices must rise to reflect this reality. Now we need to add one more layer to this analysis, because the geopolitical dimension cannot be ignored. Silver is a safe haven asset. Throughout history, when the world becomes unstable, when wars erupt, when tensions escalate, investors flee to precious metals. And the geopolitical environment at the start of 2026 is anything but calm. Russia and Ukraine exchanged accusations about civilian attacks on New Year's Day. The conflict that has been raging for years shows no sign of resolution. If anything, it is intensifying. The energy infrastructure in the region has been disrupted. The uncertainty is palpable. Meanwhile, friction between the United States and Venezuela continues to simmer. U.S. restrictions on Venezuelan oil exports have added another source of instability to global energy markets. Oil prices, geopolitical tensions, and precious metals have always been correlated. When energy markets are volatile, when major powers are in conflict, the demand for safe haven assets increases. Silver, along with gold, captures this flight to safety bid. So let us put all of these factors together and understand the complete picture. We have the Federal Reserve pivoting toward rate cuts, with the potential for an even more dovish chair after May. We have the US dollar in structural decline, down 9% last year with more weakness expected. We have silver officially designated as a critical US mineral. We have stockpiles at historic lows across every major vault in the world. We have industrial demand growing relentlessly from solar, electronics, and AI applications. We have Shanghai premiums at record highs, signaling panic buying. We have Chinese export restrictions tightening global supply chains. We have geopolitical tensions providing safe haven demand. Every single factor is bullish. Every single indicator points to higher prices. The 148% gain in 2025 was not an anomaly. It was the market beginning to price in a fundamental reality that had been ignored for years. The structural deficit was dismissed. The inventory drawdowns were overlooked. The industrial demand was underestimated. But you cannot ignore reality forever. Eventually, the physical shortage makes itself known. Eventually, the price must adjust to reflect actual supply and demand. That adjustment is underway, and it is far from complete. Where does silver go from here? The technical picture shows the metal holding above $74 with strong momentum. The fundamental picture supports prices far higher than current levels. When you have 5 consecutive years of deficits, when inventories are at decade lows, when the world's largest supplier is hoarding rather than exporting, the conditions exist for a genuine supply shock. The triple-digit silver forecasts that emerged in late 2025 are not fantasy. They are the logical conclusion of supply and demand analysis. For investors, the implications are clear. Physical silver remains the safest way to participate in this thesis. Holding real metal eliminates counterparty risk and ensures you have actual exposure to the commodity shortage. Mining stocks offer leveraged exposure but come with operational and management risks. Paper derivatives like ETFs and futures carry their own set of risks related to the reliability of the underlying holdings. The perfect storm is here. The Fed is cutting. The dollar is falling. Supply is constrained. Demand is surging. Geopolitical tensions are elevated. Every piece of the puzzle is in place. The 148% gain was just the beginning. The journey to triple-digit silver continues. Like, subscribe, and share this with everyone who needs to understand why 2026 could be even more explosive than 2025. The Launchpad is set, the countdown has begun, and we are going higher.